Hi, I'm Amit Khandelwal, founder director Sicomoro Advisors Private Limited, and with me is Mr. Abhinav Atal, CIO. Every year, as a part of our strategy, Abhinav writes a strategy note in the context of the market, and this year he has written a note beginning of the marathon. So, Abhinav, since I have a background to this note, you had written your first note in 2020, and this note is in context to that note, which is that India is at an inflection point. So, for the benefit of the listeners, why don't you give us a background and how this note came into the picture, and then we can discuss this note further.
Sure. Thank you, Amit sir. So, like you said, giving a context would help. In 2019, when we were working and we were in a lot of this debt crisis, one of the theme that was flowing and we had communicated to all our clients is that we are very clear that India is going to experience best ever decade in the history that we have seen. And we were kind of searching what could be these pieces which could fall in place and that thesis could play out. One of the thesis in 2019, that's where we had written, is that India is going to be going to witness a structural fall in interest rates, and that was the one theme where we could see that India is at an inflection point, and that's where we had written this note, at the inflection point. But little we knew then the COVID will break out. We would also had taken a kind of a backseat when actually the COVID broke out. But by 2020 June and 2021 note that we wrote, warming up for the long run, we had created this narrative that we want to now focus on what could go right for India than what could go wrong, when world was only focusing on pessimistic things. And that's when a lot of things started falling in place. But one thing you must remember is that in 2020 October, when we were giving this narrative of a long-term bull phase in the markets, especially in the context of US, Japan and then China, we had discussed with the clients, the markets also go through a phase of sideways movement. And that's where we wrote this note, beginning of a marathon, because we feel that the stamina of the capital will be tested and that's where we feel that investors will be tested to stay invested in this market, because this market now is going to go through a volatile phase. And that's where we found this marathon as a name which will be synonymous to the behavior that investors would require, and you will require a lot of persistence to stay invested in this market.
So, what you are saying is that we are in a long-term bull run, but there is an expected volatility. So, why are you expecting volatility, and why do you say that stamina of the capital will be tested?
So, if you look at the long-term macro trends for last 2 years, were very much favorable to the equity markets or overall markets, any risk capital in that sense. And one asset class that actually was facing an unfavorable scenario globally was a fixed income or the interest rate scenario. So one of the things that is very clear that is looking like is coming, is a reversal of liquidity, which was very much favorable from an equity markets perspective. So the volatility in case of reversal of liquidity normally is the scenario that plays out, is that number one thing. Number two, as we enter into a kind of post-COVID scenario, our sense is that geopolitics will play a major role. We already started witnessing what US, Russia, Ukraine scenario is panning out. We feel that US, China is anyways, it's an ongoing theme that will continue to happen. And third, as we entered into 2022, the valuations of Nifty 50 or across the board in the market have been above the averages in that sense. Just to give a sense, on the 2021 December earnings, Nifty was trading at 22 times against long-term average of 19 times. So there is a limited margin of safety in that context. So having said that, all these things combined, we feel that the volatility in the market is going to be there with these things to play out.
But if volatility is going to be very high, then a natural thing that every investor thinks is, why don't I sell? And maybe I can buy it later at a lower price. So why would you not say that the investors to do that, and rather say that you test the stamina of your capital?
So that's where it is, right? If portfolio value being up were the only reason to sell, then probably we would have lost all the opportunities to compound the wealth. And that's where again I go back to our thesis of US bull run, Japanese bull run, where there have been the scenarios of couple of years of a sideways movement. But once the market started moving up, markets never went back to those levels. So our sense is that if investors have created enough liquidity in their portfolio to meet their needs, then I think if they can stay invested, they will save on their capital gains, their expenses, and then they can focus on compounding and structural. They can shift their focus to the structurally compounding themes. One more point there to add is that although the markets would be volatile, but the Indian markets would continue to provide opportunities on the space which are going to be compounding oriented, and that's where the focus has to shift.
So, what I hear is what you are saying is that since we are into a structural bull run, it is not wise to try and time the market and rather withstand the volatility that exists.
Oh, absolutely. If you see that is the way the wealth gets created. While I'm just trying to say in other words that time in the market is more important than timing the market.
So another thing that I see in the note that you have written, and you've used this phrase several times, that India is going through a paradigm shift.
Mm.
When you say that India is going through a paradigm shift, what exactly do you mean?
So I think one of the missing pieces obviously you are looking at is the fall in interest rates. I think the trajectory of interest rates and the behavior of interest rates is going to be substantially different. I think one of the things that we have also written in the note is that inflation scenario from here on for every country is going to be very different. And one of the things that we also feel that inflation globally might not be that much favorable, but the inflation broadly in India is going to be growth supportive. So that is what we feel that one of the paradigm shift that is going to happen in that context. Second thing that we are looking at is overall sectoral, the changes that are happening sectorally, the kind of themes government has created in terms of PLI, PM Gati Shakti. They are also creating enough levers from the paradigm shift perspective. I think one of the things that while we have not covered broadly in the note, but we had written in our long-term bull phase analysis is that the kind of population mix that we have, which is more productivity oriented. Almost in 2018, the number of people who are productivity oriented have crossed the number of dependent people. All these themes are like a paradigm shift for us, and the kind of technology adoption this population is having is something that we are looking at a paradigm, because that's where we feel the paradigm shift is happening. And mind that the couple of things that are also happening on the other side, the kind of emerging trends on the digital EVs are also suggesting that the paradigm shift is here to stay for a long period of time.
So what I see is that on the back of this bullishness and a structural bullishness that you have with respect to India, you are also advocating hyper growth investing, and you've spoken about it.
Right.
But isn't it risky, especially on the back of Netflix falling, and we saw what happened in the US market? Would you still go ahead and advocate hyper growth investing?
Oh, an excellent question again, and we have tried to cover it in an elaborate way in our note. Hyper growth investing is a very new concept to India, and we have seen only two companies in that context in the country which have reasonably made it created wealth for investors. One is Bajaj Finance and second is Avenue Supermart. I think if hyper growth, although if you look at in the US context as well, when Amazon, somebody checks Amazon's history in 2010-11, they were trading at 600 times price to sales or so. Same was Apple, which was trading at 20 times price to sales. Netflix, which was again trading at obscene 400 times price to sales. Facebook was trading at somewhere around 30-40 times price to sales, if I'm not wrong. If you would have just looked at these numbers, then you would have never participated in these growth stories. What was more important is to go deeper and understand the levers of growth, their relevance in the real life of the people, and that's when we question the growth. We see a lot of these kind of stories to play out in this universe. Why we say? Because in US, maybe the population which was actually adopting this was very small universe. In India, if you see now, we have almost like 50 to 60 crore population which could be digital oriented over next 10 years or so, and the growth orientation that can come from these companies and the relevance of them from the market perspective may remain may be there from a long term perspective, coupled with the kind of support they are getting from the external capital to stay relevant is enormous. And that's where we feel that this area, with the macro context being positive from the India's perspective, should not be avoided, or one should not avoid looking at them in that context. And that's where we are looking at hypergrowth.
But are you implying, because I've seen you giving the list of opportunities which recently got listed, I'm sure you're not implying that one should go ahead and buy all of those stocks. One needs to be selective, because it being a risky space, isn't it?
Oh, absolutely. The number of names that we have given in the note are just from a representation perspective, because they have been listed under the name of that new age investing also. And I'm very sure over the period of time, like it has happened in US, or it has happened in 2000 crisis, there are a handful of names will remain. So I think what is going to be very important is one will have to be very watchful and hawk-eyed around these names to constantly evaluate their relevance, the promoters, what they are speaking in that context, to kind of look at these opportunities. Their relevance from the portfolio perspective is going to be slow and steady, and that's where one will have to adopt a staggered investment approach. I think one has to look at these investing in a very different way, because the PE and VC funds are a very different animals in that perspective. They can constantly look at for that multi-bagger kind of a thing, whereas the investor base that we cater to are looking for kind of a wealth protection and then growth. So from that perspective, allocation of that universe is not going to be immediately meaningful, because there are going to be a lot of variables that are going to be one will have to watch out how they play out. I think we cannot underplay the kind of liquidity support US has given from 2010 to 2020 to support a lot of these names at that kind of price to sales. I doubt that kind of support is going to be there in India from that perspective. So that's where we have to be very, very watchful around these names. So it's not going to be an easy task to identify these names.
I'm sure investing is not easy anyways, and this space is not going to be easy either. Moving, since wealth percolates into different asset classes, you have spoken about the fixed income perspective, and in that context, I do find a mention of InvIT, which is Infrastructure Investment Trust, and REIT, which is Real Estate Investment Trust. So, would you like to give a perspective on fixed income investment, how is it spanning out, and how do you place InvIT and REIT in the context of fixed income investments?
Sure. So, one of the things that again we had written to our investors is that in the fixed income universe, investors will have to be quality oriented. And secondly, what we had also written is that investors will have to accept the low return scenario from here on. We are still in a better scenario as far as the global scenario is concerned. But from a fixed income perspective, what we have written in a note is that we feel that 5-year plus kind of an investment duration scenario still offers a very good opportunity. But there is an investor community which can allocate from 5 years to 10 years kind of a scenario, even in fixed income. For that universe, we feel the real estate investment trusts and the InvITs are a credible opportunities, which are kind of a hybrid instruments, which offer you the fixed income kind of a yields, plus they can also offer you the upsides in case the scenario is favorable to them. I think like the hypergrowth investing, this investment world is also evolving. We have very few opportunities in that context, and again here we will have to be very watchful, because the kind of disruption the real estate has seen will continue to happen, and again you will have to be quality oriented here. But nevertheless, this we are very, very positive on this alternate investment opportunities in the listed space that we are getting, and in fact we propose that in 5-year plus kind of a universe, they have a kind of positioning from a high yield perspective, and the quality of some of these companies is very, very high. Is that what we feel?
As a part of a safety investments like fixed income, one of the things that I see that you advocate investing in gold, and you have mentioned about gold as an investment options. So what's your view on that, and why advocating gold as an investment option?
So yeah, I think gold has a relevance again from the perspective that we are very clear that we are entering into an uncertain world, because we are still questioning this liquidity reversal, how it is going to play out. The money has gone into various asset classes. It has created a lot of alternates in last couple of years. Like for example, crypto universe was, before this crash, was worth $3 trillion or so. What kind of impact a lot of these things are going to have in the world is something that is very uncertain. And from that perspective, gold as a hedge and a proven asset class for a decade, centuries, is something that we believe is going to be relevant from that perspective. Second thing that also is that there are a lot of statistical indicators. If you look at over last 15 to 20 years, the commercial banks, central banks were consistently on a reducing their gold exposure mode, and that scenario seems to have turned the corner 2014 onwards, where we see central banks are again buying the gold. Second thing that we can see, if you see the gold as a proportion of all the asset classes, be it fixed income, be it financial assets, real estate, commodities, it's at the lowest of its level in terms of ratio. And that's where we see a lot of the statistical indicators support gold as an allocation in the client portfolios. Last but not the least, I think gold is a kind of a dollar asset allocation that we get in the cheapest form in the country. We see reasonability in terms of people's expectations from the gold in terms of returns, and all this context put together, we feel that gold is going to be an asset class that will give safety in the uncertain environment. Also, it could be an asset class in this next 3 to 5 years, could be an asset class that could be a surprise factor.
So therefore one should allocate to gold as a hedge. But what percentage would you allocate going into the gold?
So there has not been any scientific formula for around it, and we have struggled for a long period of time. But what makes a sense is that gold, basically 5% of your financial assets, if it can give that hedge, is something that is psychological number that we have looked at from an allocation perspective. Gold in any case in these kind of uncertain times behaves like a liquidity providing asset class. Is that what we look at? So minimum 5% allocation is that what we suggest. I think depending on the clients and investor profile, one can look at his allocation over the period of time. But what we have seen in the investor base like India, typically gold as an asset class as an allocation typically is much higher than that. But nevertheless, we feel that 5% is a reasonable number to look at in that context currently.
So one of the things that you have done towards the end of your note is you brought in a comparison with 2013. I guess especially in context of the rising interest rate, probably there was a fluctuation in rupee dollar. So in that context, you do bring about a comparison, but you have said that that's not too much of a concern, isn't it?
Yeah. So I think liquidity thing is like an overhyped thing. I feel every time it comes into the picture, especially in 2013 again, when Ben Bernanke had commented that they are going to look at liquidity reversal after 2008-2009 money that they had kind of put into the market. Especially the markets like India, where the dependence on the foreign exchange was very high to even fund the crude bill, had kind of witnessed some kind of exodus of money flow that point of time. And if you see that point of time, the currency had depreciated from 55 to 69 overnight over the next 3 months. Interest rates had gone up from 7.2 to 9.3%, and a lot of measures RBI had to take them under the leadership of Dr. Rajan to kind of support the economy in that sense. I think a lot of investors today again are creating that kind of scenario, at least in their mind they are creating that scenario that repeat of 2013 will happen, where India was classified as a fragile 5 economy. But I think what has changed since then is the size of the economy has gone from 1.8 to $3 trillion. Foreign exchange reserve has risen from $292 odd billion to $632 odd billion in December. our dependence on crude oil bill, our dependence on foreign exchange money flow to fund our crude oil bill is not there, because our IT services revenue itself has crossed that thing. So in fact, if you have seen, since the time the announcement happened, first level of reaction was that the currency had kind of appreciated from 76 to 72. Again, it's depreciated there or itself. But last 3 years, our currency has gone nowhere in that sense. So, and one more factor, the inflation then what we used to track, which was WPI then, although was 10% odd, today we are at 4.8% kind of an inflation zone, still in a comfortable zone from that perspective. So we feel the construct of economy is substantially different from 2013, and that's where the macro has substantially changed. And that's where again I go back to our thesis of paradigm shift. The behavior of the market, fund manager, investor community has to be extremely different this time around. But again I quote the point, volatility, it's going to be there.
So you end a note by giving an example of Tesla, Facebook, Amazon and Netflix, and you have mentioned that there is a learning from these stocks. You are talking, I guess, in the context of hyper investing. Would you like to speak a little bit more on that as well?
Sure. So I think I'll connect here again to some of the things that we have tried to achieve in last couple of years by talking with a lot of VCs, PEs, that also we have covered in our note. And I'll go back a bit. I think what we were very unhappy with whenever we used to speak in this universe, their reliance on a lot of these bulge bracket investment PE firms globally. They will invest in their universe as a major reason for their investment thesis used to put us off. And that is something that we could never buy to invest in this universe. And now when we look at a lot of this investment universe in the digital side and their presence in agro-tech, health tech and other tech side as well, we are very happy to see the kind of investment opportunities that are coming. And these companies are growing at a very faster pace, and their relevance is not only to India but a global audience at large. And that's where again I'm going back to our learning from Facebook, Apple, all these companies. The companies, their relevance, and they could create some kind of products which was an innovative product, and their relevance from the real life perspective was very large again. I think the time has come that investor will have to create that optionality in their portfolio, be it a smaller portion, but they will have to do a large due diligence in terms of understanding these companies, because there have been a lot of companies which actually vanished during the course of that time. I think over the period of time, the kind of population that we have in the country, and just to give you an example, once upon a time iShare used to produce 50,000 vehicles a year, and they started selling 50,000 vehicles a month. Tata Motors saying that they will be producing and selling 5,000 vehicles a year, and what stops them from making that number a year to a month over the period of time? The kind of adoption a lot of these things will have, and their adoption is going to be very, very fast in especially the economy like India in that context. And that's where I feel hyper growth has to be looked not only in the context of the new age companies, it has to be looked also into the context of existing leaders who are creating that optionality in their business. In fact, again connecting one point here is that we are not going to be very happy with the investment universe which is completely disregarding this new age investment thesis, EV thesis, disruptive tech thesis. I think a lot of these things in the past have happened with Nokia, Blackberries, and enough examples are there. And at least we would not like to be part of that universe, because some of these disruptions just could wipe out. So hyper growth is going to be like a double-edged sword. So investor will have to create that asset allocation in their portfolio, and accordingly will have to position that in their portfolio. And that can come in various forms, like the way we mentioned VCs, PEs. We feel that we have identified some really good fund managers in that space after a couple of years of efforts.
No, asset allocation definitely is a very important aspect of any investor. So if I hear it overall, what I hear is that you are saying that from 2020 onwards, we have had reached an inflection point from where India is starting a structural bull run, and no bull run happens without volatility. So this is the period of volatility, and the advice to the investors are that keep the stamina high so that you can withstand that volatility. But the opportunity going ahead is so large, then don't try to time the market or juggle around your good investments. Otherwise, you run the risk of missing the opportunity. And the paradigm shift that you have explained so well is something that is making you very, very positive in telling the clients to even evaluate space like hyper investing, of course with a voice of caution and carefulness and diligence that one needs to exercise. And on the fixed income, you are seeing the opportunity on 5 years. You are seeing that because India is into that structural run, InvIT and REIT is also a good opportunity and should be brought into the landscape. And of course, because we are going through a disruptive world, gold is something that shall be used as a hedge in the portfolio, but not more than 5%. We don't need to be too defensive about it as well. Okay. Is that a good summary of your note, or you would like to add something?
No, I think that's a very good summary. But I think I had a couple of questions in that context, because this note, when we created, obviously we have kept a lot of our investor universe in our mind as well. Plus, it has a lot of generalized component as well, which may not be relevant from every investor's perspective. But I have a couple of questions to you from the relationships perspective. So now when we have this kind of a year, what kind of investor behavior would you like to have some of your investors to have in that in the portfolio context? And secondly, what kind of actions do you feel that you will take in certain client portfolios?
So, Abhinav, we are a big advocator of asset allocation. So at the end of it, the biggest driver of whatever gets decided in the context of client's investment is asset allocation. And once we have allocated, given our views, and you've expressed your long-term views reasonably well, which all of us believe in, so the expectation from the investors is that they will carry this belief and therefore will show the maturity to stay through this volatility, not get scared. Of course, we will have a very important role of hand-holding, and that's what our name implies also, that we are supposed to be a Sicomoro is used as a windbreak during storm, one of the characteristic of sycamore tree. So in that context, we have to play that role. But definitely that's what I would expect from the investors, is to hold the fort and, as you suggested, show the stamina of the capital by doing the right allocation.
Sure. And what kind of actions would you look at various types of investors? Because there are going to be the investors who have a cash flow which is stagnated for them. There are investors who would have a liquidity requirement. And there are investors who are going to have more money flow that is going to come in their portfolio. So how's the actions from those perspectives you are thinking in the client portfolios?
So it differs from client to client. So there are places, for example, last 2-3 years have been extremely good for the equity market. And in that context, the asset allocation must have got skewed into the equity. So it's a good time, and that's what we are advocating, to rebalance the portfolio such that your asset allocation, at least for the existing investors. What should also be done is, because there is a change in the context of the market, there are going to be new opportunities, and especially for clients where the pool of capital has got exhausted. While taking care of taxation and cost, we need to create the right allocation positioning of new investment opportunities, like hyper investing, for example, that you gave, or like REIT and InvIT, the example you gave, and figure out how to bring those into the investment universe. As far as new clients who are giving us new cash flow is concerned, we should advocate, given that you have a structural long-term bullish view and you are asking people to show the stamina of capital, there won't be any merit in trying to time the market. We may just stagger the investment, look for the right opportunity given the volatile view that we have, but we won't try to time the market too much and broadly try to make the clients invested based on the asset allocation that has been allocated to the clients.
I think that's the interesting thing. One has to actually focus on that, yeah, and that's where actually the note also concludes that how can we focus on compounding, and the focus on compounding can happen only when you focus on asset allocation from that perspective. I think those were the questions from my side.
Absolutely, Abhinav. Thanks a lot. This was a wonderful note, and I'm sure investors are going to find that interesting.
Thank you so much, sir. Pleasure is mine.